Have you ever had this happen? You spot the perfect upward trend line, the market pulls back for a retest, and you get excited. You place your entry, set your stop loss, and target. But then, the market hits your stop loss and then moves exactly where you expected it to. Frustrating, right? Well, what you just experienced is called a liquidity grab, and it's part of the smart money strategy to trap traders like us. But don't worry, in this video I'm going to show you exactly how liquidity grabs work and, more importantly, how you can use this strategy to your advantage instead of being a victim. Here's what you are going to learn today. What exactly is liquidity and how it shapes the market in ways you might not realize? How to identify liquidity zones where most traders get trapped so you can avoid falling into those traps. How to spot where the market is targeting your stop losses and how you can position yourself to profit instead. The different types of liquidity, soft sweep versus hard sweep liquidity, and how you can trade each one effectively. So, what is liquidity? Most trading coaches make this concept seem overly complicated, but I promise that by the end of this video, you'll understand exactly what liquidity is and, more importantly, how to use it to your advantage. In the context of smart money concepts, liquidity refers to those areas in the market where smart money like banks and large institutions are likely to place their big orders. Why? Because these areas are full of opposite market orders, such as stop losses and stop orders waiting to be triggered. These orders tend to pile up around key highs and lows, trend lines, and equal highs and lows. Smart money knows this, and they push the price into these zones to trigger these orders, grabbing liquidity before the real market direction unfolds. It's all part of creating a trap, whether it's a bull trap or bear trap designed to fool retail traders. But once you grasp this, you can stop falling for the traps and start trading like the pros. When identifying liquidity zones, the key is to recognize areas where the market is likely to trap traders by triggering their stop losses or enticing them into positions, only to reverse the price direction. These zones tend to form around common technical levels that retail traders frequently use, such as support and resistance levels, trend lines, swing highs and lows, and patterns like double tops and bottoms. Here's a breakdown of each. Support and resistance levels are classic liquidity zones. Many traders place their buy orders at support levels and stop losses just below them. For example, when the market forms a support level, retail traders expect the price to bounce back. They enter long positions and place stop losses just below the support. However, smart money like banks may deliberately push the price below this level to trigger these stop loss orders, before reversing the market upwards in the anticipated direction. This traps traders, forcing them out of their positions, while larger players enter at a more favorable price. Just like support levels, resistance levels are prime areas for liquidity grabs. A resistance level is a price point where the market has historically struggled to move above, attracting sell orders as traders anticipate a reversal. Many traders place their sell orders and stop loss orders above this resistance level, expecting the price to drop once it hits resistance. However, this creates an ideal liquidity zone for smart money. They know that a cluster of stop losses from short sellers is sitting just above the resistance level. To capture these orders, they may push the price slightly above the resistance level, triggering the stop losses and creating a false breakout. Once the liquidity is grabbed, the market typically reverses, dropping back down, leaving retail traders trapped and larger players in control of the market's direction. Trend lines are another popular tool where traders look for price bounces. When the price approaches a trend line, traders expect it to respect the line and reverse. They place their entries near the trend line with stops just beyond it. However, similar to support and resistance, smart money often pushes the price slightly beyond the trend line, triggering stop loss orders and grabbing liquidity. The price then reverses, leaving traders who got stopped out frustrated while institutions gain liquidity for large moves. Equal highs are levels where the price reaches the same peak multiple times without breaking through, creating a horizontal resistance level. Retail traders often interpret these as strong resistance levels and place sell orders just below the highs, while placing stop losses above them, expecting the price to drop after testing the highs. How smart money uses it. Smart money knows that many retail traders place their stop losses just above these equal highs. To grab liquidity, institutions push the price slightly above the equal highs, triggering stop-loss orders and gathering liquidity before reversing the market. This creates a false breakout, trapping traders who entered